Hi, I'm Scott Hoppy, and we're going to look at the new Trump tax law today. Specifically, I'm going to spend the next few minutes going over how the law impacts service businesses. Look at the 20% qualified business income deduction, this new deduction for flow-through businesses, and take a peek at entity selection. Should I be an S corp? Should I be a C corp? Should I be an LLC? And see what it looks like, what looks like the best decision in our examples. I work with Blue, a tax and accounting firm that's 100% distributed and digital. The team works across the U.S. And our headquarters is in San Francisco. Primarily our clients are also in the San Francisco Bay Area, and we work with businesses as well as individuals. However, not all of our clients are there, and they tend to also be in Los Angeles and Chicago, as well as other cities in the U.S. I'm Scott Hoppy, and I have my master's in taxation, my doctorate in accounting. I started my career off at PwC, and then I went in-house to a global architecture firm before working and starting Blue. Since then, I've been awarded 40 under 40 by the CPA practice advisor, and the firm's been featured in California CPA for the distributed and digital setup that we have. Let's go ahead and for me, I really love practice management and kind of combining the technology with the accounting world. With the accounting world to unlock more potential for us to have a better client experience. So now let's go ahead and look at the Trump's tax law. It was introduced, and some of the history about it. It was introduced by the House GOPs on November 2nd of 2017, and shortly thereafter, Trump signed the Tax Cuts and Jobs Act on December 22nd. And the main driver for this was Trump's promise for lower corporate tax rates. But we'll go ahead and let's go ahead and look at some of the changes for businesses as well as individuals. So for businesses, the corporate tax rate dropped from 35% to 21%. So he accomplished his goal of a major reduction there. Section 179 deductions, which is like accelerated depreciation, being able to expense new purchases. It went from a $500,000 limit to a $1 million limit. So we got a lot more breathing room there. And bonus depreciation, which acts similar to 179, where we can immediately take an expense on property purchased. Before that only applied to new property, now it applies to used property. Not a bad deal, especially when you start thinking about, like restaurant owner who would go out, spend $100,000 on equipment for the restaurant, and they'd go, yes, you know what, we bought this equipment, it's new to us, thinking they're going to get this full bonus depreciation. But what ends up happening is they actually bought it secondhand from a restaurant that went out of business. So even though it's new to them, it's considered used property, and they weren't getting the immediate deduction. Now they would, and that's kind of a nice deal. For individuals, we also saw lower tax rates. The top bracket went from 39.6% to 37%. So that was a win. We had another win. The standard deduction nearly doubled to $12,000 from just about $6,300. But we had a few losses, and the losses look like the SALT limitation of $10,000. That's the state and local tax limit, and that was a major deduction for individuals in high tax states like California. So for our clients who easily went from a $60,000 deduction, maybe most people are getting that are like a typical San Francisco salary. They're down to a $10,000 limit, so they've lost $50,000+ of deductions. Another loss was the mortgage limitation went down to $750,000. And Bay Area housing prices are high. That $750,000 mortgage limit, not that hard of a ceiling to hit. And then another loss was AMT, the alternative minimum tax stays. It was on the chop block. I was rooting for it. I was rooting for it to go away, but it stayed. However, the impact of it's a little bit less because they've increased the threshold for you to get into AMT quite a bit, about 500,000 or a million. 500,000 for single, million for married filing jointly, and the huge reduction in itemized deductions, mainly that SALT limitation of 10,000. That's going to help keep people out of AMT anyways. A lot of AMT was getting triggered because you had really high deductions for your income. So overall, your exposure to AMT is probably a lot less, but you really got to look at your own facts. But the biggest win, and where we're going to spend the rest of our time, is the Section 199A deduction. That's also known as the QBI deduction. And what it means is your 20% tax-free deduction for doing nothing additional. It's a free deduction. All you have to do is qualify for it. And we'll look at how do you qualify. Well, you're looking at if you're a service business or not a service business, and if you're a service business, especially a specified service business like an accountant, an attorney, a doctor, if you make under $315,000, you get a 20% deduction, free and clear. But that 20% deduction goes away between $300,000 and $415,000. So where you really don't want to be is you don't want to make $400,000. You either want to make under $315,000 or you want to blow $415,000 out. If you make between $315,000 and $415,000, you're getting the most punitive tax possible. And that's because you're losing the deduction, you're getting taxed more heavily, and you know what, you're just not managing your tax brackets effectively to reduce your tax exposure. So there's a tax trap there. You get a free 20% deduction, but you fall between this phase out and you're in the trap. So what we want to do is work to stay out of that trap and stay within the 315. Let's take a look at an example of what this means in actual dollars. So Joey's a software engineer. He's married, 51 years old, and a California resident. His business is formed as an LLC, and he is the sole owner. In 2018, he made $375,000, had expenses of $75,000, and reports net income of $300,000. So he's under that $315,000 threshold. He would get $60,000 of the QBI deduction, 20% of $300,000. And his total tax is $90,604, just about 30%. That tax includes IRS, self-employment taxes, California taxes, and LLC fees of $1,700. So on $300,000 of income, he's taxed $90,000 to get a rate of 30%. But let's look at same facts or same example, slightly updated facts. So now Joey's making $700,000 and he has expenses of $139,000. It's an expense ratio of 20%, just like in the prior example. And so he's reporting net income of $561,000. $561,000 over the $315,000 threshold, so he would not get the QBI deduction. And his total tax is now $214,000, 38%. So he's moved up and has been taxed quite a bit higher. So what can you do? There's three things we can think about easily. One is you can manage your brackets. We manage your brackets by looking at equipment you need to get and making that purchase now, e.g. like computers. We also have other things we can control around expenses. And we can control, we can use defined contribution plans like a 401k or defined benefit plans, also known as like pension plans, where you can get some huge deductions. The other thing we can do is play the brackets. So how do we play tax brackets? Joey's in that he's getting taxed at 38%. Well, he can hire family. Maybe he has a kid to mow the lawn, have him mow the lawn at the office, pay him $12,000 a year. The standard deduction is $12,000. That money's tax free. So Joey pays $12,000. He saves nearly $6,000 on taxes. Not a bad deal. And then the last piece we can look at is entity selection. And like, should we be an S corp? Should we be a C corp? So let's keep looking at our examples. Let's keep looking at Joey. So now we're going to look at managing tax brackets. So the same tax as before, where Joey made $700,000, and he had business expenses of $139,000. Except now Joey's managing his expenses through a 401k and defined benefit plan contributions. He has contributions of $261,000. That's $200,000 of defined benefits and another $61,000 of 401k. So he reduces his net income back to $300,000. He would again get $60,000 of the QBI deduction, and his total tax is back to $90,000. The best part of this is that $261,000 that Joey just put in, that he just created expenses for, went right back into his pocket. He didn't give it to someone else. It went to his retirement. He avoided a tax rate of nearly 48%, nearly 50%. He avoided on taxes on that $261,000. That means if he didn't do that contribution plan, it would have costed him $124,000. So instead of spending $124,000 and giving it away, he's now kept $261,000 for himself. Not a bad deal. Not a bad deal at all. So here's the numbers again, kind of broken out. We have gross income of $700, expenses of $139, net income of $561, but then we do the defined benefits of $200, 401k of $61. Now we have net income of $300. We're back to our QBI of $60,000, and we get to our tax of $90,000. But now let's look at entity selection and management. Entity selection is the decision of, do I go from a sole proprietor to an S corp? Do I go from a single member LLC to an S corp? Do I go to a C corp? And an entity management is really making sure you're taking your expenses correctly, so you're not mismanaging the entity that you have and not creating more taxes than you should. How that normally looks for us is, as like an S corp, entity mismanagement would be overpaying yourself payroll, something higher than reasonable compensation. Now let's go ahead and look at 3 examples of entity selection and the tax impact. So here's our old facts from the very beginning. Joey, single member LLC, back to $375,000 of gross income, $75,000 of expenses, tax of $90,000. But what happens when Joey decides to be a S corp? All right, Joey's an S corp. He has net income now of $300,000. But instead of having that whole 300,000 subject to self-employment tax, like he was when he was an LLC, now we're going to manage that. So we're going to give him owner payroll of 150,000. So only that $150,000 is going to be subject to payroll tax. And we're going to give the other 150,000 out to him as a distribution. So he's still going to pull $300,000 out of the business, get it in his pockets, but now he's going to pay $8,000 less each and every year he does this in taxes. He's going to reduce his tax rate to 27%. Pretty good deal there. But we're looking at this and we go, well, what about back in the beginning, Scott? We were just talking about how the C Corp, the tax rate dropped down to 21%. Why not just be a C Corp? The rates are pretty low. Well, good question. Let's take a look at the C Corp structure for Joey in our example and see what the impact is. Same information, same as the S Corp. He's going to pay himself $150,000 and he's going to take a dividend of $150,000. As a C Corp, there's the lower tax rate, but there's also double taxation. And because of that, Joey's going to pay, with the same facts, $121,000 or 40.3% in taxes. That's a pretty big jump. But let's look at all three of them side by side, from lowest to highest. If Joey was an S Corp, he would have the best answer for him with these facts. As a single member LLC, he's somewhere in the middle. As a C Corp, it's the least advantageous for him. But really, this is just for example purposes. It may make sense to be a C Corp. You may have a different structure, different facts that really align for you to take advantage of that. In this case, the S Corp worked out pretty well for Joey, and $8,000 each year over 5 years, that's $40,000 extra dollars in your pocket. That definitely more than pays for my fees to make this happen for you and to take care of the compliance side of things. So it's something to consider. What I want you to do with this takeaway is, I want you to, one, know if you're a service business, because that really dictates, do we care about the $315,000 or not? You want to know if you're the best entity for your scenario. Should you be an S Corp or a C Corp? And if you're subject to your service business and you're subject to that $315,000 limit, really, I want you to manage your expenses and manage your brackets so that you can maximize the 20% deduction. Don't lose that freebie. So with that, any questions that you have for me, just message Scott at whyblue.com. I'm happy to field them, talk with you, and have you as a client. But if you're just looking for a quick overview on tax law changes for the individuals and businesses, follow the tiny URLs, and I have that on the blog site. But I really look forward to hearing from you, and thanks for your time and attention. Have a nice day. Bye-bye.